Most retirees pay far more in taxes than they ever need to. Today, I'm going to show you how someone like Sarah can reduce her federal tax bill from $35,000 a year to nearly zero, while still spending $160,000 a year on the life she worked for. Sarah is 61. She's retired with $1.9 million saved, $1.1 million in her IRA, $600,000 in a taxable brokerage account, $200,000 in her Roth IRA. She wants $160,000 of spending each year. If she pulls everything from her IRA, her taxable income spikes and her tax bill lands around $35,000. Over 5 years, that's $175,000 gone. Not because she saved too much, because she withdrew in the wrong order. Idea one is to separate your spending from your income. Most people assume that spending equals taxable income. It doesn't. If Sarah sells $100,000 of stock that she originally bought for $60,000, only the $40,000 gain shows up on her tax return. The original $60,000 was already taxed years ago. So instead of pulling $160,000 from her IRA, she pulls a slice from the IRA, a larger slice from her brokerage account, and finishes with her Roth IRA. She still spends $160,000. Her taxable income drops into the mid $60,000 range. Now she fits inside her standard deduction and the 0% long-term capital gains bracket. That combination takes her federal tax bill close to zero. Idea two is about pulling money in the right order. Wealthy retirees don't guess, they follow a sequence. Step one is to pull $15,750 from the IRA. This fills her standard deduction at 0% tax. Step two is sell from the brokerage account and realize gains up to the 0% limit. She gets a large portion of her spending money at a 0% tax rate. Step three, finish with the Roth IRA to reach the full $160,000. Same lifestyle, radically different tax outcome. Idea three is to clean up gains while they're free. Sarah's taxable account is $600,000. Her cost basis is $360,000. She has $240,000 of unrealized gains. If she ignores these gains, she builds a future tax time bomb. Wealthy retirees avoid that by using the 0% capital gains bracket as a yearly opportunity to clean up those gains. Each year, Sarah sells appreciated investments, realized gains up to the 0% limit, uses what she needs for spending, and reinvests the rest immediately. The key point is there's no wash sale rule for gains. She can buy back the same investment the same day. Each time she does this, her cost basis rises, her future taxes fall, and that $240,000 gain shrinks at 0% tax. Idea four is to use Roth money when you need invisible income. Some withdrawals show up everywhere. Your tax return, Medicare, ACA subsidies. Roth withdrawals don't. They are tax-free. They're invisible to Medicare. They're invisible to ACA income calculations. When Sarah needs extra spending power, she can pull from her Roth without triggering hidden penalties. I'll break this one into a separate video because this strategy deserves a full deep dive on its own. Tying this all together, Sarah spends $160,000 a year. And with the typical approach, she sends about $35,000 of that straight to the IRS. Over 5 years, that's $175,000 gone. When she applies these four ideas, she spends the same amount, and her tax bill drops near zero. Those avoided taxes stay invested. They extend the life of her portfolio. They increase her future spending capacity, and they create a calmer, more confident retirement. If you want to see how this looks with your numbers, there's a link below where you can connect with us directly. We'll walk through your accounts, your income needs, and the opportunities hidden in your current plan. No pressure, just clarity. You worked hard for what you've built. Your savings deserve strategy. Your retirement deserves confidence. You're not behind. You simply need the right plan. Thanks for watching. I'll see you in the next video.